Good morning. This is your weekly update with Jim Stewart. I'm the Chief Investment Officer here at Worth Asset Management. Today is October 2nd, 2023. We just finished off the third quarter, and most markets finished the quarter on the negative downside. The Congress averted a shutdown over the weekend, and the fourth quarter is now upon us. So let's take a look at some charts and the news of the week. So let's jump on in.
Okay, let's go over the top three market headlines from last week. The stock market settled for the week mixed as the NASDAQ and small caps finished slightly higher, while the S&P fell for the fourth week in a row, slipping to its lowest level in nearly 4 months. The index fell less than 1% for the week and nearly 5% in the month of September, now declining for the second month in a row in a momentum shift that's starting to erode much of the stock market's year-to-date gains. All right, the first one that we're going to go over is yields. With the notable exception of the two-year Treasury, yields of most categories of the government bonds extended their recent climb, with the 10-year Treasury yield rising above 4.5 for the first time since October of 2007. Similarly, the 30-year yield eclipsed 4.7, its highest mark since February of 2011. All right, along with yields going up, the dollar is also rising, and so is oil. You can see from this chart that all three are going up, and WTI crude oil futures jumped more than $7 a barrel this month, settling Friday at just over $90 per barrel, which is starting to stoke lingering concerns about inflation expectation, rising gas prices, and a slowdown in consumer spending. On Friday, we got the inflation PCE, which is the Fed's preferred gauge for tracking that inflation mark. And it's, even though it's been slowing at a monthly pace since November of 2020, we are seeing the core PCE, which excludes food and energy, coming in at 3.9 on an annual rate, which is still twice as high as what the Fed is hoping for. And all three buckets inside of that, goods, housing, and non-housing services, all are declining. Now, as you can see from this chart, the core goods are definitely declining the most, while housing is finally starting to tick over. Now, but when we look at the PCE core services X housing on a year-over-year basis, it has been over for almost 4.45 for the past couple years. So we can anticipate, again, higher for longer until these numbers start to come down. All right, let's go over the top 10 asset classes, their performance, and how we're positioned on a 3-week basis and a 3-month basis. On a short-term basis, the only two bullish categories are US dollar and commodities, while gold for the week and short-term turned bearish. If we zoom out on an intermediate term basis, again, we still only have the US dollar and commodities, while everything else is in the red, while the S&P and NASDAQ, as I said last week, if they tick down again, they will turn bearish, and they did. All right, let's look at the chart of the S&P 500. As I said last week, there was this huge gap that we needed to close, and last week it did. It came back down into this resistance zone, and it popped right above it, and now it's basically sitting on the top end of it. So as I said, it had to close that. Now where it goes from here, unclear. We could probably start trading here, but the thing that you want to notice from this chart is, for the first time, we are seeing lower highs and now lower lows. That is a trend reversal, especially on the S&P 500. So until that changes, the trajectory is lower. All right, let's go over the top 3 market movers for this week. On Tuesday, Wednesday, we get jobs data in JOLTS and ADP, which tracks private sector payrolls. And then Friday, we get the non-farm payrolls. And for August, if you remember, the economy generated 187 200,000, which was lower than the 271 projection. Well, September's coming in right now at 163, which is even lower than last month. So you're starting to see that the jobs start to come down. Number three, it's the thing to be kind of listening for is we're having companies come out and start to scale back their earnings expectations. And if they know that their numbers are going to be lower, they come out and pre-announce, and they're starting to do that. 74 companies have now pre-announced on the negative side, while 42 have provided a more positive outlook. So that'll be something to keep in mind and watch as we head into the third quarter earnings season. That's it for this week. Thank you for joining us. Our next update is Monday, October 9th. As always, continue to subscribe, like, and follow, and we shall see you next week. Have a great week trading.